Hey everyone, and welcome back for another deep dive into the world of finance. Today, we're going to be looking at some really interesting trends that are happening right now in March of 2025. And we'll be taking a look at gold, Forex, and U.S. stock indices. So we've got some really fascinating excerpts from market analysis, gold, Forex, and U.S. stock indices, March 2025, to guide our conversation today. And a couple articles from Reuters.com and MarketWatch.com, just to kind of give us a broader perspective of what's happening.
Yeah, I think it's a really interesting time right now to be looking at the markets because, we've got a lot of global events that are kind of influencing investor behavior. And it's creating this ripple effect across different asset classes. So, whether we're talking about gold or Forex or stocks, it's all kind of interconnected.
Yeah, it's funny you should say that because it really is like this chain reaction. One market sneezes and the rest catch a cold. So let's start with gold. It's been having quite a week. It gained a solid 1.7%. It's currently sitting pretty at $2,911 per ounce.
Yeah, that's right. Gold being a safe haven asset is really sought after right now. There's a lot of uncertainty in the market, and I think with the whole trade talks thing that's going on, plus that upcoming U.S. jobs report, everybody's kind of holding their breath a little bit, like what's going to happen next.
Right. So for someone who's maybe listening to this and thinking, hey, maybe I should jump on this gold bandwagon, what are some of the things that they should be watching for to kind of know what's going on?
Well, from a technical analysis perspective, as long as gold stays above that support level of $2,087.89, we could see it continue to trend upwards. Think of a support level like a safety net. If it drops below that, it could signal a reversal of the trend.
So it's not just about hoping for the best you actually have, these technical indicators that can kind of give you a little bit of guidance.
Exactly. And looking a little deeper at the charts, we could even see gold hitting some resistance at $2,388.01. Or even, climbing as high as $2,434.35. You can think of resistance as sort of like a ceiling, so it might take some extra effort for the price to break through that level.
Okay, so if you're thinking about investing in gold, those are some key targets to keep an eye on. Now, silver seems to be telling a slightly different story. This week it dipped a bit, down 0.1% to $32.58 per ounce. What's going on there?
Well, silver is interesting because it's got this dual personality. It's a precious metal like gold, so it benefits from that safe haven appeal. But it's also an industrial metal, It's used in everything from electronics to solar panels.
So is it possibly reacting more to that industrial side of things right now?
It could be, yeah. I think investors are maybe just holding back a little bit, waiting to see what that jobs report tells us about the health of the U.S. economy. If the economy slows down, demand for industrial metals could weaken, and that would definitely have an impact on silver.
Yeah, it's fascinating how all of this stuff is connected.
It really is. And speaking of interconnected markets, let's move on to Forex. We're seeing a lot of consolidation and range-bound trading in some of the currency pairs. For example, URUSD is hovering around that 1.3575 support level.
Now, I know Forex can be a little bit of a head-scratcher for some people. Could you break down what consolidation and range-bound trading actually mean?
Sure. So imagine you're watching a tennis match, and the ball keeps bouncing back and forth between the baselines, staying within a certain area of a court. That's kind of like range-bound trading. The currency pair is stuck between these two boundaries. Support level acting as a floor resistance level, acting as a ceiling.
So price is kind of like ping-ponging between these two levels.
Exactly. And consolidation just means that the pair isn't making any huge moves up or down. It's kind of like the players are taking a breather, waiting for a big serve to shake things up. And in the Forex market, those big serves are often major economic news releases or big policy decisions.
Gotcha. So it sounds like it's a little bit of a waiting game for USD right now. What about GBP USD? That one seems to be on more of an upward trajectory.
It is, yeah.
Even with some consolidation this week, GBP USD is holding on to its bullish momentum. So for anyone who's following this pair, those support levels at 1.6990 and 1.6920 are definitely worth watching. If you're bullish on the British pound, those levels could be good entry points.
So even when there's consolidation, you can still find opportunities if you know what to look for. Now, IUESD had tried to break through that 0.9440 resistance level recently, but it just couldn't quite make it. What does that tell us?
Well, it suggests that the buyers just weren't strong enough to push the price above that level. So it's now trading within a range like that tennis ball we were talking about, bouncing back and forth.
Yeah.
If it continues to weaken, we could see it drop to the bottom of that range. And if that 0.9320 support level doesn't hold, we might even see it sink to 0.9200. So traders are going to be keeping a close eye on that 0.9320 support because that could really determine the pair's next move.
Now, USD-CAD is giving us something called a bullish fakie pattern. That sounds kind of interesting. What's happening there? Yeah, this pattern can be a little bit deceptive. It starts with what looks like a breakdown below support, almost like a fake out, hence the name. But then the price quickly reverses and bounces back up. So USD-CAD hit that support at 1.0620 and then rebounded, which could be a sign of a potential upward trend.
So it kind of tricked those who thought it was going down.
Exactly. And now if prices stay above 1.0620, we could see further gains. But of course, if it drops below that support level, then it could signal that the downtrend is resuming. So it's really all about watching those key levels and seeing how the price action unfolds.
It's like this whole game of strategy, reading the signals and trying to anticipate the next move. Lots to keep track of in the Forex market. Now let's turn our attention over to the U.S. stock indices. It seems like investors are a little bit on edge this week, reacting to everything from trade tensions to company earnings reports. Let's start with the Dow Jones Industrial Average. It took a little bit of a hit this week. What are you seeing there?
Yeah, the Dow dropped 1% on Thursday, and it's now sitting 5.4% below its recent high. So concerns about those tariffs are definitely weighing on investor sentiment. And it'll be interesting to see how the Dow reacts to that upcoming economic data. And any news related to trade, those factors could be major drivers for the index in the short term.
So it sounds like we need to keep a close eye on those trade talks and economic indicators. Now, the Nasdaq Composite has officially entered what they call correction territory, which sounds a little ominous. Can you explain what that means and what's driving it?
Sure. So a correction is simply a decline of 10% or more from a recent high. It's a natural part of market cycles, although it can be unnerving for investors. In the Nasdaq's case, we're seeing a combination of factors at play. Trade tensions are a big one as they create uncertainty for businesses and could potentially impact global growth. On top of that, some major tech companies have issued disappointing revenue forecasts, which has further dampened investor enthusiasm.
So it's a mix of global anxieties and company-specific concerns. And the Nasdaq is down a substantial 10.4% from its December high. So that puts it firmly in correction territory. I know some of our listeners might be feeling a little uneasy seeing those numbers. What advice would you give to someone who's invested in the Nasdaq?
Well, it's important to remember that corrections are a normal part of the market cycle. They can actually be opportunities to buy stocks at a discount. But it's crucial to have a long-term perspective and not panic sell. If you're concerned about the volatility, consider rebalancing your portfolio to make sure your investments align with your risk tolerance.
That's good advice. Don't let those short-term swings derail your long-term investment strategy. Now, the S&P 500 is also feeling the heat. It's down 1.8% on Thursday. What's the outlook for this key index?
Well, the S&P 500 is often seen as a broader gauge of the overall U.S. stock market, so its performance is closely watched. Right now, it's hovering near its 200-day moving average, which is a key technical level. If it breaks below that support, we could see further declines.
So that 200-day moving average is kind of like a critical line in the sand. What else should investors be watching for when it comes to the S&P 500?
Well, upcoming inflation data will be important. If inflation comes in hotter than expected, it could put pressure on the Federal Reserve to raise interest rates more aggressively, which could potentially slow down economic growth and impact corporate earnings. And speaking of the Fed, their next policy announcement will be closely scrutinized. Investors will be looking for clues about the future path of interest rates and any insights into how the Fed views the current economic landscape.
Wow. So it sounds like there are a lot of moving pieces to keep track of. It's like a financial chess game with multiple players and strategies at play. What are some key takeaways from all of this for the average listener who's, trying to make sense of these market trends and maybe feeling a little overwhelmed by all this information?
That's a great question. First and foremost, I think it's important to remember that market fluctuations are normal. We've seen periods of volatility before, and we'll see them again. The key is not to panic and make impulsive decisions. Instead, focus on your long-term investment goals and make sure your portfolio is well diversified.
So don't get caught up in the day-to-day noise. Focus on the big picture. Easier said than done sometimes, though, right?
It can be challenging, but it's essential. It's also a good reminder to stay informed about what's happening in the markets and the global economy. Knowledge is power, especially when it comes to investing.
And that's where the deep dive comes in. We're here to help make sense of it all.
Precisely. We aim to provide you with the insights and context you need to navigate these sometimes complex financial waters. We've covered a lot of ground today. From gold's safe haven status to Forex's intricate dance to the stock indices roller coaster ride, what are some key trends that stood out to you?
Well, the ongoing trade tensions are a major theme that just keeps popping up. They're impacting investor sentiment and creating uncertainty across multiple markets. It'll be crucial to watch how this situation evolves in the coming weeks and months.
I agree, and it seems like economic data, especially the U.S. jobs report and inflation figures, will be key drivers for market movements in the near future.
Absolutely. Those data points will give us valuable insights into the health of the U.S. economy and could influence the Fed's decisions on interest rates. Before we wrap up, I want to touch on something we haven't discussed yet, the potential implications of all these trends for the global economy. What are your thoughts on that?
Well, that's a crucial question and something that economists and policymakers around the world are grappling with. If trade tensions escalate further, we could see a slowdown in global growth,
Right.
which would impact businesses and consumers everywhere.
It's a delicate balance, and the stakes are high. As we've seen throughout this deep dive, the financial markets are interconnected and constantly reacting to events on a global scale. So as you go about your day, think about how these market trends might impact your own financial decisions, your business, your community, and the world at large.
Yeah, it's a fascinating and ever-evolving landscape, and we're here to help you make sense of it all.
Now, for those who want to delve deeper into specific areas, we'll be providing links to our sources in the show notes. Whether you're a seasoned investor or just starting out, there's always more to learn.
And remember, knowledge is the best investment you can make.
That's a great note to end on. We'll be back next week with another deep dive into the world of finance. Until then, stay curious, stay informed, and stay ahead of the curve.
It's a bit of a wild ride out there, isn't it?
It really is. So much is happening right now that it's hard to keep up with it all. But that's why we do these deep dives, so we can make sense of the chaos together. So we've talked about gold, we've talked about silver, we've talked about Forex, those currency pairs that are always kind of like doing their own thing. But now let's talk about those big players, those U.S. stock indices. The Dow, the Nasdaq, the S&P 500. They seem to be feeling the pressure a little bit this week.
They do, and it's not surprising given the current climate, We've got those trade tensions looming over everything. And then you've got company earnings reports that are coming in a bit mixed. Some are exceeding expectations while others are falling short. So investors are understandably a bit cautious right now.
Yeah, it's like they're trying to figure out which way the wind is blowing before they make their next move. So let's break it down, starting with the Dow Jones Industrial Average, a.k.a. the Dow. It had a bit of a rough day on Thursday, didn't it?
It did. It dropped 1%, and it's now 5.4% below that recent high. I think those tariff concerns are really weighing on investor sentiment right now.
Yeah, because those tariffs could have a ripple effect, right? Not just on the companies that are directly impacted, but on the broader economy as well.
Exactly. It creates uncertainty, and when businesses are uncertain, they tend to hold back on investments.
Which then slows down economic growth, and nobody wants that. So it'll be really interesting to see how the Dow reacts to any new developments on the trade front, as well as those upcoming economic data points that we were talking about earlier.
Definitely, those could be major catalysts for the index in the short term.
Okay, so the Dow is down, but it could go either way depending on what happens next. And let's talk about the Nasdaq Composite. It's officially entered what they call correction territory. I know that sounds kind of scary, but what does it actually mean?
So a correction is basically a decline of 10% or more from a recent high. And you're right, it can sound a little bit alarming, but it's actually a pretty normal part of market cycles. Markets don't just go up in a straight line, they tend to fluctuate. And sometimes those fluctuations can be pretty significant.
So it's like taking a step back before taking 2 steps forward.
That's a good way to put it.
So what's driving this particular correction in the Nasdaq?
Well, as we've already discussed, those trade tensions are definitely playing a role. They create this cloud of uncertainty over the global economy. And that makes investors a bit hesitant to put their money into riskier assets like tech stocks.
Which is what the Nasdaq is heavily weighted towards, right?
Exactly. And then on top of that, you've got some big tech companies that have recently issued some disappointing revenue forecasts.
Oh, yeah. I saw that some of those big names are expecting slower growth in the coming quarters.
Right. And that's not exactly music to investors' ears.
So it's a combination of those broader global concerns, plus some company-specific issues that are weighing on the Nasdaq.
Precisely. And when you add it all up, it's no surprise that the index has fallen into correction territory.
So the Nasdaq is down 10.4% from its December high, which is definitely a significant drop. I'm sure some of our listeners who are invested in the Nasdaq might be feeling a little bit anxious right now.
I can understand that, but it's important to remember that corrections are a natural part of the investing journey.
It's like those bumps in the road that you inevitably encounter on any long trip.
Exactly. And just like those bumps don't necessarily mean that you're going in the wrong direction.
A correction doesn't mean that the long-term outlook for the market is bad.
In fact, corrections can sometimes present buying opportunities. because they allow you to buy stocks at a lower price.
So it's not necessarily a time to panic and sell everything.
Definitely not, unless your investment goals or your risk tolerance have changed.
But it is a good time to maybe reevaluate your portfolio.
And make sure that your investments are still aligned with your overall strategy.
Right? Because what might have been a good investment a few months ago might not be the best fit for your portfolio today.
It's all about adapting to the changing market conditions.
And speaking of adapting, the S&P 500 is also down this week. It fell 1.8% on Thursday.
Yep.
So what's the outlook for this key index?
Well, the S&P 500 is often seen as a barometer for the overall U.S. stock market because it tracks a much broader range of companies than the Dow or the Nasdaq.
It's like a snapshot of the health of corporate America.
Exactly. And right now, it's hovering near its 200-day moving average.
Okay. And remind me, what's a moving average again?
So a moving average is basically an average of the closing prices over a certain period of time.
So in this case, we're talking about the average closing price over the past 200 days.
That's right. And technical analysts use moving averages to identify trends and potential support and resistance levels.
So is this 200-day moving average acting as a support level for the S&P 500 right now?
It appears to be, but if the index breaks below that level, it could signal further declines.
So it's like a critical line in the sand.
In a way, yes. If the S&P 500 can hold above that 200-day moving average, it could be a sign that the bulls are still in control. But if it falls below that level, then the bears might take over.
And nobody wants to be around when the bears are running wild.
No, they can be a pretty grumpy bunch.
So what are some other things that investors should be watching for when it comes to the S&P 500?
Well, those upcoming inflation figures that we've been talking about will be crucial. If inflation comes in hotter than expected, it could put pressure on the Federal Reserve to raise interest rates more aggressively.
And that could potentially slow down economic growth.
Right. And if economic growth slows down, then corporate earnings could suffer, which would obviously be bad news for the stock market.
So it's all connected, isn't it?
It absolutely is. Everything in the financial world is interconnected.
And speaking of the Fed, their next policy announcement is coming up soon.
Yes, and investors will be hanging on every word. They'll be looking for any clues about the future path of interest rates and any insights into how the Fed views the current economic outlook.
And it's a lot to keep track of.
It is, but that's the nature of investing.
It's a constantly evolving game with lots of moving pieces.
But it can also be incredibly rewarding.
Especially when you take the time to understand the forces that are driving the markets. So what are some key takeaways for our listeners who are maybe feeling a little bit overwhelmed by all of this?
Well, first and foremost, I would say don't panic. Market fluctuations are completely normal. We've seen periods of volatility before, and we'll see them again. What's important is to have a solid investment plan in place and to stick to that plan even when things get a little bit bumpy.
So don't let those short-term swings derail your long-term goals.
Exactly. Remember, investing is a marathon, not a sprint.
It's about pacing yourself and staying focused on the finish line.
And it's also about staying informed. The more you understand about the markets and the factors that are driving them, the better equipped you'll be to make sound investment decisions.
And that's why we do this show right, to help our listeners navigate the complex world of finance.
That's right. We're here to provide you with the insights and context you need to make informed decisions about your money.
So whether you're a seasoned investor or just starting out, we hope that you find our deep dives to be both informative and entertaining.
We certainly try our best.
So before we move on to our final thoughts for the day, let's quickly recap what we've covered so far. We talked about gold, which is still holding strong as a safe haven asset. But silver's a little bit more uncertain right now because it's got that dual role as both a precious metal and an industrial metal. Now, we talked about those Forex pairs. Some of them are consolidating while others are trending higher. And then we moved on to the U.S. stock indices, which are all down this week due to a combination of factors, including those ongoing trade tensions and some disappointing company earnings reports.
That's a lot to take in, I know.
But it's important to be informed about what's happening in the markets, even if you're not actively trading.
Because those market movements can have a real-world impact on our lives.
Exactly. They can affect everything from interest rates to inflation to job growth.
So it's in our best interest to stay educated about what's going on.
Now, before we wrap up, I want to touch on something that we haven't really discussed yet, and that's the potential impact of all of these trends on the global economy as a whole.
That's a great point.
Because what happens in one market doesn't stay in that market, right?
Exactly. Everything is interconnected.
So if the U.S. stock market is struggling, that could have ripple effects around the world.
Absolutely. Investors might start pulling their money out of emerging markets, which could lead to slower economic growth in those countries.
And then that could come back and hurt the U.S. economy as well.
It's a delicate balance.
It really is, and it's something that we need to be mindful of as we navigate these uncertain times.
I agree. It's really quite fascinating when you think about it. We've got gold, which is seen as this kind of like, safe haven asset. And then you've got those volatile Forex pairs.
Yeah.
And then the U.S. stock indices, which are kind of like, a reflection of the overall economy. And they're all intertwined in this really complex way.
It's like they're all pieces of the same puzzle. And when you put them together, you start to get a clearer picture of what's happening in the world.
Exactly. And that's why it's so important to take a holistic view of the markets. You can't just focus on one asset class or one economic indicator. You have to look at everything together to really understand what's going on.
So for our listeners who are maybe feeling a bit overwhelmed by all of this information, what's the one key takeaway that you would want them to remember as they navigate their own financial journeys?
I would say focus on the long game. Don't get caught up in the short-term noise. The daily headlines, the market fluctuations, all of that. It's just noise.
It's easy to get distracted by that noise, though, especially when you see those numbers going up and down.
I know it can be tempting to try to time the market or chase the latest hot stock tip, but in the long run, that's usually not a winning strategy.
So what should investors be doing instead?
Build a diversified portfolio, one that aligns with your risk tolerance and your financial goals. And then stick to your plan.
Easier said than done sometimes, right?
It can be challenging, but it's essential for long-term success in the markets.
So patience and discipline are key.
Absolutely. And don't forget about education.
Right. The more you know about the markets, the better equipped you'll be to make sound investment decisions.
There are so many resources available these days. Books, websites, podcasts, you name it.
Including this one, of course.
Exactly. We're here to help you on your financial journey.
Well, we've covered a lot of ground today. From the allure of gold to the volatility of Forex to the ups and downs of the U.S. stock market.
It's been quite a ride.
But hopefully our listeners are feeling more informed and empowered to navigate these complex financial waters.
That's our goal.
And remember, this is just a snapshot in time. The markets are constantly changing, so it's important to stay informed and to adapt your investment strategy as needed.
Absolutely. The only constant in the markets is change.
Well said. Thank you for joining us for another deep dive into the world of finance. We'll be back next week with more insights and analysis. Until then, stay curious, stay informed, and stay ahead of the curve.